In this video, we're going to be talking about hacking your way to paying off your mortgage early. But first, help me help you by clicking that subscribe button below, as well as the notification bell, so that you can be alerted every time that we do a video. We do a lot of real estate related videos trying to help you in the real estate world. So, for our scenario today, as we're discussing these numbers, going over these, I just want to point out here that we're going to be talking about a $350,000 loan at a 4% interest rate, 30-year mortgage, okay? So that's what we're basing these numbers on. Obviously, if your loan amount is different, which it probably is, there are a lot of different mortgage calculators, amortization schedules that you can find online. Dave Ramsey's got a really good one if you head over to his website that you can see this stuff. I don't agree with everything Dave Ramsey does or says, but he's got a lot of good things, and this is one of the tools that I actually really like. So again, $350,000 loan, 4% interest rate on a 30-year mortgage. So a lot of people, you just want the magic pill, right? You want the magic pill. What's this crazy solution that nobody knows about that I can pay off my mortgage early? Truth be told, to pay off your mortgage early, you've got to make extra payments. So we're going to be going over that today. Now, why it's important to make those extra payments. If you did bi-weekly payments, a lot of lenders will let you set up to where you do an automatic draw or an automatic deposit into your mortgage every 2 weeks. By doing that, the reason why people suggest you do that, the reason why I suggest you look into doing this, is by doing bi-weekly payments, you'll actually make one additional payment every year by doing so. If you did that on the loan with the example that we said, that one extra payment a year will pay off your mortgage 4 years early and save you $35,000 in interest. So that's $35,000 that's going to stay in your pocket rather than paying the bank by doing the bi-weekly payment setup. The other option as well, I personally don't love the bi-weekly setup. I would rather just make extra payments every single month rather than doing the bi-weekly. So what you can do is you can take that one extra payment, or whatever your payment is, take that, divide it by 12, and that's going to give you the amount to then spread out over every single month to add up to the one extra payment at the end of the year, right? Now, in our example, that would be $140 a month additional. That's nothing, right? $140 a month isn't going to break your bank when it comes to making an extra payment. So if you add that $140 a month onto your monthly payment, you'll equate to an extra payment a year. Now, what I suggest you do, if you can, is round that number up. Try and round up to an even 100 number. And so if you round 140 up to 200, so if you pay an extra $200 a month on your mortgage for the life of the loan, you're going to save, instead of $35,000 in interest by making the one extra payment, you're going to save $52,000 in interest, and it's going to shave 5.5 years off your mortgage. So now that we kind of understand why you should be doing this, ways to make it happen, okay? So one, go and get a side hustle. There's a lot of opportunity out there. You can be an Uber or a Lyft driver. You've got DoorDash these days. If you don't want to be out driving your car all over the place, find like an online hustle. There's a lot of things that you can pick up, extra side work. Fiverr, check that out. Indeed, you can check that out. If you're creative, go create an Etsy store. There's all sorts of stuff that you can do to create extra money and then roll this into making that extra mortgage payment. Here, though, is the tip that I really want to share with you guys with what's happening in the market today and how real estate in Utah is really just booming. So what we want to do is, if you have purchased a home, and when you purchased that home, you did not put down 20%. So if you put 3% down, 5% down, you did a 0 down loan, those were really popular a couple years ago, then what you need to do is you need to look at what you're paying in PMI, in mortgage insurance, every single month. I would assume it's safe to say that you're paying between $100 and $300 a month on mortgage insurance. And the reason why that's happening is because you didn't put 20% down. But here's the thing. If you are now to where your loan to value ratio is 80%. So if they say, well, you still owe $300,000 on your mortgage, but your home is appreciated since you bought it to where now that ratio is 80%, you can call into your lender and you can get that mortgage insurance removed. So to help you do this, if you want to know if you're at that 80% loan to value ratio, leave a comment below or shoot me a message and I'll get on it, pull up comparable home sales and see if you're at that ratio, because we can save you that couple $100 a month. But here's the thing, you've got to be disciplined enough to take that extra couple $100 a month. Don't change your payment, just make that extra couple $100 a month part of your principal payment. So you're paying extra principal, shaving years off your loan, saving yourself tens of thousands of dollars in interest. Hopefully you guys found this video helpful. We're going to continue to be sending out videos like this. So that again is why you need to subscribe and hit the notification bell so that you can stay up to date in the real estate world. Thanks.